Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And we've all been keeping an eye on the markets, and I think sometimes the trader really starts to feel like, man, stocks have gotten really low. Or at other times, when markets are a little bit stronger, boy, some stocks seem to be really high. But compared to what? That's actually the question that we're going to be attempting to address today. We're going to be using a technical study known as a linear regression line. And actually, we're going to be combining three different types of linear regression lines into one trading system that is specifically designed to look for identifying extreme lows and extreme highs and potentially assisting the trader in identifying entry and exit signals. So this is going to be an interesting discussion, building an entire short-term trade system using a combination of linear regression lines. But before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see Janelle and Wacky, Lucky Angel. Who else is out here? We have Ted. Hello there. Rojo, Crispy, Frank, Kelly, Life in the Fast Lane, Michael, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archives after the live stream has concluded, enjoy the recording. It's a great way to watch these webcasts. But if you'd like to be here in our live stream audience, this is a Friday webcast series. We kick things off promptly at 1 Eastern time. Now, I also want to let my live stream audience members know that my very good friend Scott Thompson is hanging out with us in the chat today. Scott and I have been working together now for 20 plus years. So Scott brings a ton of experience to this discussion. Scott's going to be keeping an eye on any questions that come in the chat window in the live stream. And if I can't get to those, Scott's there to pick up my slack a bit. So thanks for having my back there, Scott. Scott and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. You can find Scott and me on X. You can find Scott there at Scott Thompson CS. You can find me on X at Cameron May CS, and you can also find and follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. But let's get into this discussion of building a short-term trade system using a combination of linear regression lines. Now, of course, as we do, there are going to be risks associated with this system, as there are risks associated with other approaches to trading and investing. So bear this important information in mind. This material is intended for general informational and educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risk, including the loss of principal. All right, so with that important stuff accomplished, let's set the agenda for today. So first thing that we're going to do is look at our existing positions, or look at what were our existing positions. The choppy markets have chopped down the last of our couple of trades, so we'll see what happened with those. Then we'll look at market conditions right now, use that as a little bit of a backdrop to set up a discussion of using linear regression lines to build a custom chart system for trading in the short term. So a lot to cover. Let's go right to the Thinkorswim platform. And yeah, as we go to our monitor tab, we look at our advanced charting group. There's nothing there. What happened to it? If we go to our account statement, you can see that we were stopped out of our ADM position. We were stopped out of our APH trade. And that's the way things go sometimes when markets get a little bit bearish and most of a portfolio is built around bullish approaches. That's the way it works. Yep. So let's go to the charts tab. Let's have a look at Archer Daniels Midland first. So this was our last trade from a couple of weeks ago. This was our TTM squeeze trade. If you need to go back and see the logic of the signals, the logic of the indicators, and the logic of how the trade was planned and placed, you can always go back. I shouldn't say always, because there are some of our webcast series that aren't recorded, but the vast majority of the time, what you can do is go to our YouTube channel, check the playlist, the archives for our previous webcast, and get caught up right there. So if you're new to our channel, welcome. It's great to have you here. Make sure you subscribe right now. You can click on the subscribe button right down below the video stream. But our Trader Talks channel is where we host our live streams. So you can join live streams right here. But you can also find playlists of previous discussions. So for example, we did our ADM trade. Let me scroll down here through all the different webcast series. My series is kind of right in the middle. There's advanced charting techniques. So if I click on view full playlist, this discussion right here, Kevin filled in for me last Friday. This discussion here is where we had our TTM squeeze discussion, planned this trade. So getting back to the chart, what we saw here was that our stock had gone through a really solid quiet period as identified by that series of red dots on our TTM squeeze indicator. Then when we get that first green, we look at the direction of the histogram bar, and this was a blue bullish bar. So we took a bullish trade right here. And unfortunately, the market's had other ideas from that point. Pulled back down, we re-entered that channel. We were stopped out right there, trade over. That's the way some of them go. So that's what happened with ADM. We also had, was it APH? I always think ATH, but yeah, this was Amphenol Corporation. And this was constructed using a different strategy set. So let's load up our APH, ADX, and MACD strategy. So what we were looking for here was the ADX to be below 25, which indicates a sideways trend. We had that again. And then we're looking for the MACD to maybe indicate where we are within that trend. A low, bright red MACD transitioning to dark red right here was a signal that we might be near a support ready to bounce. So we took a bullish entry here, kind of hung in there for a couple of weeks, and they were just nipped out right there. So that was the end of that trade. Small loss in this case. That's the way, again, some trades go. And that's why we have plans for if the trade works out, and also plans to try to minimize the risk exposure if the trade starts to stumble. So there's our Amphenol trade. Now let's get ready to maybe plan and place a new trade. Cecil says Cameron has so many strategy sets. Yep, in this webcast series, one thing I want to avoid doing is giving the impression that there is a particular study or a particular arrangement of studies that's the best arrangement, or it's appropriate for every investor. Rather than taking that approach, my real role is an educator. So what I like to do is just mixing things up. I'm kind of like the guy at the home improvement store that's just showing a different tool each Friday. How do you use this one? Yep, so we just explore that. And I think that way my audience can build their own very robust toolbox of potential strategies and approaches, and then just pick the one that seems to work, or the combination of the ones that seem to work best for them. All right, but let's go look at the S&P 500. And what I do in this series, one thing that I do is that on a weekly basis, we do use the same set of technical indicators to review the S&P 500. My purpose there, again, is not to promote a specific strategy set, but it's to introduce some continuity into this series, so it doesn't just feel like we're always starting from square one. Barbara says, do you use certain study sets for different lengths of trades? Barbara, absolutely, some traders might do that, but I will say most of the technical approaches that I introduce us to in this series are very portable from one time frame to another. We wouldn't even necessarily need to customize most of those. We might just switch the time frame from a daily chart to an hourly chart or a weekly chart, and trade basically the same symbols. So, not symbols, but signals. Anyway, let's load up our S&P 500 strategy set. So we're going to go up here to our studies. We're going to load up our TVM, Trend Value Momentum strategy set. So with this set, what we're looking to do is confirm, does the trend look bullish or bearish? Does there appear to be short-term value, or do prices seem to be overpriced at the moment? And finally, what's happening with momentum of a stock or an index? So trend value and momentum. So our trend indicators are doing something new. We haven't seen this. Haven't seen this for about 9 months. Actually, it was more than that. Back here, more than a year. Our 50-period triangular moving average has moved down below our 100 period. And what a trend trader or investor who uses this combination of technical tools might conclude from that is, boy, there's been a real softening of trend. So what do we see right there? That's what I'm talking about. That green 50 triangular moving average slipping down below the 100. 100 is still going up though, okay? So for those that have that sort of longer term outlook, they may still be bullish. But what I'm going to do with this information, for the first time, I'm going to scale down the new trade that we take today until we see this 50 climb back up above the 100. I'm not going to be taking full-size positions, taking a little bit more cautious approach. That's one adjustment that some traders might make. Others might just decide to not do anything. I'm afraid that wouldn't lead to much learning in my webcast series if we're not doing anything for a series of weeks. You might say, why don't we just do some bearish options? I don't do a lot of options. I don't do any options trading in this Friday webcast series because I want to keep the focus on the charts. And as soon as I introduce options, then I have to spend a lot of time explaining that strategy. And then it becomes more of an options discussion. So I don't do that. Anyway, so that's our adaptation that we're going to make here. It's kind of a check for the bears, which we haven't done in a long time on our trend indicator. Now the bulls have an argument down here. Our RSI has not only gotten below 40, it's getting very close to traditional oversold areas. You see we're at 30.24. When markets are persistently bullish, quite commonly a technical trader will move up their requirement for RSI to get oversold just to get below 40. We're getting right on down there to 30, which we haven't seen since back in April of last year. And you can see that turned out to be an important turning point for the markets. So this kind of called to mind the discussion that I wanted to have today. I think there are very likely a lot of traders out there saying, boy, stock prices sure do seem low right now. And they are low. What are we, 8% lower than the S&P all-time high? Let me just double check that. I do have a curiosity here. Let me go up to the high here, click on that, pull down to the low. And it looks like, yeah, we're actually between 8 and 9% down from those all-time highs. Starting to push toward bear market territory. But from a technical perspective, we got a bearish vote for the trend indicator. This may actually be bullish being this low. So I'm gonna say check for the bears, check for the bulls. And finally down here, our momentum. We were starting to get a kind of a bullish shift as we saw what I call a red shift, bright red transitioning to dark red. That's kind of gone back to bright red. That's more of another check in the short term that over that momentum time frame for the bears again. Yeah, Cecil says, it's not like you can't find me teaching some option strategies, right? Yeah, I do that in other webcast series every single week. So you can go check those out if you want to see options being applied. Here we just stick with stocks because that just simplifies the whole thing for my audience and allows us to keep the focus where I want it to be. All right, so yeah, it doesn't necessarily appear to be like, let's say, an optimized technical scenario for taking a new bullish position, at least to those using this TVM strategy approach. But so what we might do there is just adjust things down. But I think you can see a case here where some traders will say, but shouldn't we be contrarians? Isn't the whole point to buy low? Don't we have to go down in order to have that buy low, sell high opportunity? Yep, that's what we're going to be taking as an approach. Now, Eric is suggesting maybe we do a bearish stock position. It's a little bit better. I could do that. I'd still have to spend a long time explaining, like, let's say if we were to sell some shares short. I'm not going to do that because there's a lot that goes into understanding how that works as well. I will say selling short is an assumption that stock prices are going to go down. And sometimes we make an assumption that doesn't turn out right. Instead, the stock price goes up, and stock prices can keep on going up, which means that selling short has unlimited risk potential. That's the one thing I will say about that. It's not a recommendation or anything like that. I just want to say anytime I bring up short selling, I got to mention that it has unlimited risk. Anyway, so we are going to be doing a bullish trade today, putting ourselves in the shoes of that trader who might be saying, sure seems like stock prices are low. Sure wish I had some way to define what is, to move away from this sort of fuzzy, seems like it's low. How might we define that, boy, stocks, according to at least one technical approach, are low, and maybe some of them are set to go up again? So we're going to be using a linear regression approach. So how many of you are familiar with linear regression lines? Got 160 people watching. I'm guessing, I don't know, half or fewer might be afraid. It might be afraid. Sorry, I read the word afraid there, James. Anyway, might not be familiar, or no, half or fewer are probably familiar with linear regression. The other half, I want to make sure that we get everybody up to speed. Okay, so let's do this. Let's come over here to the S&P 500. I'll just start right here at the top. I'm going to pick on NVIDIA. Click on that. And let me clear off our technical studies. Let's remove all of these and just start with a nice fresh lens. Okay, so it looks like, Barbara, you're not familiar with linear regression, and however you pronounce that name. Another one, no, don't know about linear regression, says Art Vandalay. Chris says familiar, haven't really used it much. Okay, so Kelly says, I'm not sure. Anyway, here's what a linear regression line, okay. Thinking about that concept of, boy, it sure seems like stock prices are low, as we use NVIDIA as an example. Yeah, prices were certainly higher, and they're certainly pretty low right now compared to where they have been, but still, there's that uncomfortable lack of definition when we say it seems low. So what a linear regression line system does is it compares price levels to where normal price levels are. How do we establish normal? I'm going to give you an assignment here. If you look at this 1-year chart, if I were to challenge you to draw a line through this chart, that it's just a straight line going left to right, but with one purpose here, draw that line as close to the middle of prices as you can. In other words, don't get too far away from the higher prices. Don't get too far away from the lower prices. Where might you draw that line? Well, if I try to draw, let's say, a middle line through, let's start down here. The middle of these first few weeks might have been down here. And then if I try to connect that with today, notice I'm missing a lot of stuff up here. So I don't know about drawing a middle line through there. I might have to start somewhere over here and catch a lot more of the price activity through all of these stronger months while not getting too far away from these lower months. But basically what we're trying to do is define where is normal for the last year. So I'm going to remove this one. I'm going to say maybe our line's somewhere around there, where we're relatively close to all of these prices. We're not getting too far away from these prices down here. And there's actually a tool that will just draw that for us. It is called the linear regression line. It's a linear means associated with the line. I guess that'll be a workable definition for that. And kind of regressing back to the first part of the year, right through the middle of all price activity. So I'm going to go up here to our flask or beaker icon. It's a flask. And I'm going to type in the word linear. And the first thing I'm going to choose, notice that there are a number of these lines. We're going to be using this one, and then we're going to be using this one, and then we're going to be using this one. But we're going to start with linear regression trend line and add that to our chart. Now the word close here is important. I'll tell you what that refers to in a moment. But I'm just going to click apply and click OK. It looks like I didn't do too poorly. That was pretty good. The start point was pretty good. Anyway, but this line is literally drawing, it's just drawn right through as close as it can to the center of all price activity, right? So for some traders, what that might do is kind of define for them a couple of things. Number one, what the trend has been this year. And the trend on NVIDIA, even though it's been mostly flat for a period of months now, overall left to right, it's been up, and this just makes that maybe a little bit clearer. But it also might help a trader start to define how far has the current price diverged from what's normal. Now, specifically, because I mentioned as I applied this linear regression line that it uses close. So yeah, it uses closing values. So it's orienting itself to the center of all the closing values of the year. All right. So I'm going to right click on my line. That was just to sort of illustrate the point of what this other line is attempting to do, but the other line does it better than I do. So there's our linear regression trend line. And so a linear regression trend line trader might look at today's price and say, boy, we're pretty far. Is this the farthest we've been all year? Maybe not quite. So I'm now going to move on to the second linear regression line tool. So we're going to wind up using 3 here. Let's come up here to our Flask icon again, type in linear again, and I'm going to add a linear regression channel. Add that to our chart. Now again, notice it's using closing values, but what it's going to do is it's going to draw a line above and below our linear regression trend line that captures 100% of the closing prices for the entire year. So it's just going to go to the most distant closing price, and it's going to draw a parallel line right out there, parallel to our linear regression trend line. And then it's going to draw a matching one. So let me show you how that works. I'm going to click, actually, let me do this. I'm actually going to thicken this up just to make it, I know that the linear regression trend line is kind of thin. Let me click on the little gear icon. And for my middle line, I'm going to change that to a thickness of 3 out of 5. It's going to wind up with an upper line and make that 3 out of 5, and a lower line, make that 3 out of 5. So let's click OK and click Apply. Click OK again. So here's what this is now doing. In the middle, we still have the original linear regression trend line. And then what this study does is it looks at the most distant close from that line all year. Now, if you look at right now, we're awfully close, but actually just if you really squint, let me zoom in a little bit. You can see that right now we're still a little bit above that lower linear regression line. So if I zoom back out, it's not using today. Looks to me like it's actually using one of these 2 days. I'm guessing it's probably this candle right there. That closing value on probably April 21st was the most distant close from that linear regression trend line. So what this does is it draws a parallel line that intersects with that most distant close right from the linear regression trend line, and then it draws an identical one. Let me do this. I'm going to click here and draw up from that. There we go. That's basically the distance to that trend line. Then all we do is we just duplicate that, and we draw a second line above the linear regression or the trend line that's exactly the same distance. That's how those distances are determined. So it's literally not attempting, but actually capturing 100%. That's where the 100 comes from. 100% of all the closing values for the entire year. Now, for some traders, what that might do is define for them, have we actually reached an extreme low? And as we look at right now, I think it's very interesting. This is now, as of this moment for NVIDIA, just about exactly the same distance from that trend line. This is the furthest we've gotten from normal as defined by our original trend line as we've seen all year. And for some traders, what that might do is it might give them a little bit of more confidence that this may be an opportunity to buy at extreme lows. Now, does that guarantee that prices are going to rally right from here like they did the last couple of times? Nope. But they may have a plan for that. So that is, let's see, John says, Cameron, doesn't using linear regression contain the growing to the sky assumption? If so, how might an investor address such an assumption? I'm not familiar with that, John, so I don't know how you would address it. My apologies. I'll have to do a little bit of additional research. I like to consider myself a fairly veteran investor and trader, and I think I'm familiar with most technical or trading or investing phrases get batted around out there, but not that one. So I don't know. Anyway, but what would a technical trader do here? They may actually buy just as price approaches that we'll just call it the minus 100 linear regression line, with the plan that if we can get a rally, it might rally right back on up to the trend line. It's kind of a reversion to the mean assumption. Sometimes it works and sometimes it doesn't. But we're not going to be operating entirely on that assumption. Let me just remove this one drawing that I just made. And we're going to add a second linear regression channel. So I'm going to go back up to our Flask for the final time today, type in linear regression, and I'm going to add the 50% line. So what this is doing, let me click apply. No, actually, let's thicken this one up as well. It's going to be a different color. It's going to be the green one. I'm going to make it thick though. Let's make it center line 3. Let's make the upper line 3 out of 5. Lower line 3 out of 5 as well. Just makes it easier to see. Actually, it might be helpful. I know that there are those, let me do this. Let me click OK. I don't need to do this. I typically, when I use green and red, I like to also make the lines different colors because not everybody can see the difference between green and red. It doesn't matter. It's going to be obvious anyway. So I'm just going to click apply here and click OK. And what you'll see now is that a second envelope has been drawn around that original center trend line. So what is this doing? Well, it's just splitting the difference between the trend line and the 100 line in half. It's the 50% line. So this isn't attempting to capture 100% of all closing values. It's just attempting to capture 50%. And for some traders using, let's say, more conservative entries, a little bit more conservative exits, this may generate a much higher degree, a much higher frequency of tradable signals. Okay, Ricebird says it's very interesting. The S&P linear regression channel looks so much like NVIDIA. Yeah, is there some overlap between the S&P and the largest company in the S&P? Yep, there is. But here's how a trader might take this linear regression. And again, maybe with an assumption of a regression to the mean or toward the mean. Let's first of all talk about where entries might be taken and then where exits might be taken. So entries are pretty much anytime we approach one of these trend lines from the upper side, the upper side, like in this case where we're pulling down, traders might buy just as we approach that trend line and then plan to exit if we can recover and get back up to the next linear regression. So in this case, it might be from the minus 100 to the minus 50. All right. Now, a second signal might be as we're approaching from the underside as we cross above one of the lines. In that case, entry might be taken with the plan to get out at the next line above that, and so on. So we might be entering at the 100 and selling at the 50, entering at as we cross the 50 and selling at the what I might call the 0 line or the trend line. Then if we cross through the trend line, entering at the trend line and selling at the next line, which is now essentially plus 50. And in this case, we see an example of where a signal didn't really work out, kind of faded. All right, so let's see. Looking to see. Kelly says, yeah, looks similar to standard deviation channels. Yeah, you're going to see similarities between this approach and lots of other similar, let's say, envelope systems where we have a center line defined in some way, and then we go a certain percentage or deviation from that. So like quite commonly, somebody will say, isn't this kind of like Bollinger Bands? Yeah, it's kind of like it, but significantly different as well. Yep. But let's maybe take this well, actually, we've kind of talked about the fun side of the trade. That getting in, waiting for profit arrives, we take the profits, that's fun. Sometimes it doesn't work out though. So for example, as we were crossing the plus 50 line, maybe there were some traders who took that as a signal and they were hoping to get right up to the plus 100 line, and you'll notice the stock faded instead. So how might we manage the downside of the trade? Well, some people use this as a ratio exit. So what I mean there is if we're trying to go from 50 to 100, Well, maybe if we go from 50 to about halfway back down to zero, so if you might imagine an imaginary, let's say 25 line, right in the middle here, that may be a stop level. Price is going the wrong direction. And what that might do is it creates a ratio where we're relatively close on each entry to having at least $2 of reward to every $1 of risk. So if we apply that sort of a ratio approach to where we are right now, look at this, we're sitting right at that minus 100 linear regression line. Let's just assume that our trader takes the entry. And no, they don't always require that there's a, let's say, a white candle to reassure them that price is going back up. Just being very close to that linear regression might be enough for an entry. So if we were to buy right now, looks like we're buying right around 167. Looks like we're right about 168 at the moment. The plan may be for price to get back up to this line, which is close to 186. So 168 to 186, about $18 move to the upside. Well, half of that distance might be the stop below our entry. So $9 below the this lowest linear regression line, for example, might be the exit. Wacky, that's pretty funny. All right. Thank you, Johns. You say, as to the expression growing to the sky, it suggests that trends generally don't continue growing perpetually. All right, I'll still have to investigate that, because over the long term, there is the assumption that most stocks and most markets, given enough time, will tend upward. Not everybody does, though. And some of that long-term tendency is, of course, has its own inherent bias, because we're using indices to track stocks that are actively managed. Not the same Dow 30 right now that it was 100 years ago when it was first constructed. So the stocks that have underperformed have been removed, and better performing stocks have taken their place, and that certainly contributes to that upward bias over time. Doesn't fully explain it, but we have to be aware of that. Anyway, so I think I'm going to do a trade today. This is going to be our example trade, but let's just take this new knowledge that we've gained using our linear regression line system, and how about we just bang through some stocks, maybe start at the top, move down, randomize it, and just see how things are looking. How about we go to Apple and see what's going on there? Very interesting again. I don't think this is going to be unusual right now, but a lot of stocks may be right down near that lower linear regression in some, or maybe even many cases, defining the parameters of the linear regression with today's current price or close. Although it looks like it was actually the close from maybe about a week ago defining the parameters of this linear regression. It looks like we did get right up here. That's kind of interesting, isn't it? If this is right through the middle of all price activity, kind of interesting for Apple that the absolute high was almost precisely proportionate to the most distant low from that trend line. That doesn't always work that way. You might think it does. It doesn't. Let's go on to Microsoft and see what it's up to. Looks like it's just getting closer to its lowest linear regression. But you can kind of see consolidation ranges right around those linear regression lines. Let's see, Amazon, has it been paying attention to lines? Looks like it's a bulk of its trading happened between the 100 and the plus 50. But maybe a trader here might be waiting for things to come down a little bit further. Let's look at Alphabet. There we go. This is kind of what I expected to see quite a bit right now. Alphabet is at its most distant, and by a pretty fair margin, for the entire trailing 12 months. Barbara, you like that we're going through a list of stocks? Okay. Yeah, how about let's get out of the big ones, and I'm just going to sort of scroll randomly, just sort of zip down and stop. And let's maybe look at some of these. So there's Fastenal right at its linear regression trend line. So this one, it was kind of chopping back and forth between the 50 and the 0, and it slipped down below the 0. Maybe this one might be a setup for, let's say, a bearish trade. ETR, boy, it just hit you can see this is the strongest move of the year. And so that has defined its regression lines for the year. But it is interesting how the others just sort of retrofit themselves to the current normal. Anyway, I think you can see how a trader can get some quick repetition with a new concept, practice it. But let's put this one directly into practice. Let's place a trade. All right, so the plan here is let's take an entry. We're going to be buying somewhere around 168. Our target, let's just put it right at 186. You can see that's where that minus 50 regression line is. So that'll be at about an $18 reward potential. And we'll put a stop down $9 below, let's say 168. So that would have us around 159. All right, so let's go place our trade. Go to our trade tab, make sure that we're looking at the right stock. Let's right click, and we're going to scale this one back because remember that our 50 triangular moving average is crossed down below the 100, might not be looking as technically strong out there. I don't think that's going to be a huge surprise to a lot of people. But instead of putting $5,000 into a new trade, maybe we'll do 2,500. All right. So that would get us about 15 shares, I think, just some rough math there. So let's put in a custom buy order with a stop. Going to buy about 15 shares. There we go. And actually, I selected with a stop. I didn't even mean to do a stop. Let's do that again. Right click, buy custom with an OCO bracket. That's going to allow us to put in a sell order to take profits if they arrive or arise. We're going to take losses if that's what happens. So let's link these three orders together so that when I change my quantity on the buy order, it's automatically changed the quantity on the sell orders. And for right now, let's put in a market order. Obviously, what that does is it gives us it gives us a better chance for a quick fill, but we may not be thrilled with the price that we get. It looks like it's going to be a little bit over 168 right now, but we'll see when that order fills. We're going to put in our target. Well, that's a limit order already. We're going to put our target in at 186. That was up at that minus 50. And we're going to put on our stop just about 25% outside of our lowest linear regression. So that's going to be about 159. And we'll make both of those good till canceled. So if we're able to again fill at 168, gives us about $18 of reward potential. If we fill around 168, about $9 of risk there. So I'm going to click confirm and send, buying 15 shares of NVIDIA, and I wanted to keep it around 2,500 bucks. Yep, that's close enough. We're going to have our target up there at 186, our stop at 159. There's no commission on this trade, but there can be on some types of trades. And of course, a stop order is not a guarantee that that's the price that we receive. If the price is collapsing rapidly, or if it gaps overnight, it's certainly possible we might sell for a lower price than that. So let's click send. And let's see what we fill this thing for. It is a market order. It should, filled pretty quickly. 168.11. All right. So we've accomplished it, guys. And what we've done today is we've used 3 linear regression studies, just layered them on top of each other to construct a custom linear regression trading system that's intended, as you see, probably for the short term. An average trade is probably only going to last a couple of weeks. But also, it's intended to identify price extremes. When we feel like, boy, price sure is low, boy, when we feel like it doesn't price feel high, this may give us a more definitive definition. Oh, it's terrible. That's redundant. That's a horrible way for me to say it, but you get it. There we go. Anybody have any questions left that I didn't address? Let's just take a quick look. I don't think so. I think we're good. All right, everybody. But we've reviewed our current positions. We looked at the markets through that TVM strategy set lens, and then we planned and placed a new trade using our brand new linear regression short-term approach. I really enjoy these Friday webcasts. I hope you do as well. We'll be back again next Friday. Is that right? Nope, not next Friday. Next Friday is going to be a holiday. So it'll be a couple of weeks, but this is what we do on our Fridays. We explore different technical approaches to planning and placing trades. Scott, thanks for helping out there in chat. Definitely appreciate it. Everybody, I'm going to let you go enjoy your weekend after you watch the final few webcasts here. But as you do, just remember you have a great slate of educational resources available to you from Schwab Education. And that includes the webcast archives. So do yourself a favor here. If you haven't subscribed to the channel yet, make sure that you go down, click on the subscribe button. It only takes a second. It doesn't cost anything to do that. But our Trader Talks Schwab Coaching webcast channel on YouTube is where you can join our live streams right here. You can also find playlists of previous webcasts, just like I've shown. You can find my series, and you can learn about the TTM squeeze, trading with ADX, that trend value momentum combination of indicators that we used for the S&P 500 we discussed right there. A lot that you can learn using those archives. Another thing that Scott and I would suggest you do is to follow your favorite Schwab presenters on social media. You can find Scott and me on X. You can find Scott on X at Scott Thompson CS. You can find me on X. Here's my handle, at Cameron May CS. I'm very active on X. And if you reply to one of my posts, I just try to reply right back to you. It allows for interaction that's not available anywhere else, just on social media. If you want to contact one of your favorite presenters, social media is the place to do it. So you can find and follow me on X. You can also find and follow and interact with me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. All right. Everybody, thank you for giving me your time today. I will see you for this series. It's going to be a couple of weeks, but otherwise, I will see you on Monday for my regular other series for the rest of the week. So I'll look for you there. I'll also look for you on social media. Thanks for all the thumbs up. Definitely appreciate that. 160 people are watching this live webcast, and it looks like 55 of you already clicked the thumbs up. Thank you for doing that. That's like applause to your presenter, but it also gives my videos a really nice boost in the YouTube algorithm. Helps more people find these discussions. So thanks, everybody. But go enjoy your weekend. I'll see you in a future webcast. I'll also look for you on social media, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.